Welcome to Work is Good, a CSM podcast. My name is Landon Buteau, and I host this show with my dad, Chris Buteau, the owner and president at CSM. We generally upload a real estate and housing market update combined with a mortgage question on Tuesdays. I'm going to start splitting that up. It'll be a bi-weekly housing market update, and on the in-between weeks, it'll be a mortgage question of the week. So I'll try and make that clear in the title. This week's episode is a mortgage question of the week that we had a few weeks ago, but it's one that I think is really interesting and continues to be relevant. So I hope you enjoy this week's mortgage question of the week.
The question is, if you have someone who's a homeowner right now and they are looking at buying and they're considering keeping their home instead of selling in order to buy their new home, keeping it, maybe renting it out. So we've touched on before in some videos the debt to income ratio and how that can be a limiting factor. Generally speaking, that's one of the main limiting factors in terms of what you can qualify for, in terms of what kind of a loan you get. Your overall debt can't be more than 50% of the income that your underwriters deem as usable.
Right.
Is that general description?
Generally true for Fannie Freddie programs, yes.
Okay. So,
Someone
yeah,
with
there's
decent credit.
obviously exceptions,
Right,
but as a general rule.
That's a good general rule.
And so if that's the case, and you're looking at keeping a house that you have a mortgage on and buying a new house, how does that debt to income ratio then factor in?
Yeah, so it does. So that's kind of the short answer for that is it does.
Like, is there a
factor
combined
in.
debt to income ratio?
And, well, what they're doing is debts are like if you have a car payment or student loan payments. Of course, that's easy to calculate, right? It's however $100 a month you're making on that payment gets included in your debts. But on a piece of property that you own, that's not the subject property. So the subject property is the property that is the subject of the mortgage you're being underwritten for.
Mm-hmm.
So in this case, you're buying a new place. The subject property has its own.
Let's say Woodinville, Washington is the new property.
Yeah.
And Duval is the old
Yeah,
property.
and so you're on Woodinville, of course, you're going to have your principal and interest on your mortgage, your taxes, your homeowner's insurance, and all that's going to factor into your debts. But then the departing residence that you're leaving
In Duval.
also has all of those things as
Yeah.
well. That's right. And so the ideal situation is, and this is not everybody for sure, is where you can qualify carrying that departing property as just dead weight, right? No income offset. So that's the ideal situation where you don't need to have a renter in that property. You don't have to have a rental agreement.
In order to qualify.
Right, in order to qualify. Because then that's, then it's simple. It's just, you're buying a new house, that's one of your debts, but you have enough income to qualify, so you just show them your mortgage statement that shows all the, the taxes and insurance and principal and interest, and that gets added in and you're fine.
So are you saying there may be then scenarios where your usable income can include rent from your previous property?
Yes, and so that's a situation that's more likely for a lot of people, as most people can't afford to carry two properties dead weight, and so then you typically have to have a rental agreement signed and a security deposit deposited.
Okay. In order to use that income.
In order to use that income, and then that income is an offset against that mortgage payment.
So if you have that situation where you're looking at buying, you just have to start lining, and you needed that income to qualify. You just have to start lining up your renters, get that all taken care of, start lining up your renters, and then go get underwritten for your new mortgage.
Yeah.
Okay. Nice, great. Real quick, we're at our 3 minutes, but why not do that? Like, is there any obvious reason not to do that if you can?
Not to retain the existing property and buy the new one?
Like, if you can offset the mortgage by the rent effectively, so you're not adding more payments, at the very worst case scenario, they even out. So your old mortgage you're keeping, but then you offset it with the rent you're getting, or close. Why not do that?
Yeah, just different people
Just
have
what you
different
can
risk
afford,
tolerances,
yeah.
right? And different, also just appetites for real estate as an investment. You got to manage the real estate. You've got the risk associated with damage to the property. You've got the risk associated with renters, getting into the property, and you've definitely heard horror stories, and so. I mean, rental. I think you can certainly be a real estate investor prudently and take precautions and minimize those exposures. You can never minimize. You can never eliminate the exposure of different elements of owning real estate. Right, property values go down, rental values go down. I mean, those are risks, but I think generally they go up.
Yeah.
And so, I think that's not a bad approach. The other main impact there is, a lot of times when you're buying a new house, people use the equity of the old house in order to invest in the new house, and that can be the biggest challenge. Is that you're leaving that equity parked in that house, and it's hard to get to. So that can be the biggest challenge. But
there are solutions of maybe refinance that and use some of that equity
potentially, but by the time you're ready to do that, well, that's also no longer going to be a primary residence, right? If you refinance this property, you have to say you're going to occupy it as a primary for a year. Otherwise, you're refinancing it as an investment property, and that's likely going to drive your cost of money significantly up.
Then it gets less practical.
Yeah.
Makes sense.
So,
great. Well, more to talk about there, but it's helpful for now.
Thanks for listening to Work is Good. If you enjoyed it, share it with someone else, leave a review, and listen next week.